When people talk about investing in stocks and stock market, they often think about America and the United States. They think about the S&P 500, about companies like Google, Amazon, Facebook, and Meta. But Germany is often left out of the conversation. Germany is the third largest economy in the whole world and home to a lot of industrial and manufacturing companies and famous companies such as BMW, Mercedes, Audi, Bosch, Saab, Bayer. Germany is often described as the powerhouse of Europe, and this video is going to be, should Germany be part of your investment portfolio? Because Germany is known for high quality, high precision manufacturing and industrial products. It's known for being a global exporter of goods. But at the same time, it is facing some difficulty when it comes to an energy crisis. It's facing some difficulty regarding competition from China, and its manufacturing sector has gone through a hard time. So the question should be, should you invest in Germany? Should you include German ETFs and stocks as part of your investment portfolio? So this video is going to look at the history of the German economy and stock market, the case for and against. It's going to look at if you should hedge or not, and all other questions surrounding the question of should you invest in Germany. Now we're going to start by looking at the history of the stock market, of the German stock market, because you have to understand the history if you're going to understand why the German stock market is as it is today. Now, unlike a lot of other countries, the German economy didn't start post-World War. Germany has a long history, a decade-long history regarding its economy and its strength in industry and manufacturing. Already in 1871, Prussia won the Franco-Prussian War and Germany became one country. Its industrial strength started. A free economic zone was established between the various parts of Germany, which previously were different countries. Its manufacturing industrial sectors rose. It became known for its universities, its technical experience, for its engineering schools. A lot of new scientific discoveries were made. New companies were made in manufacturing of chemicals, in manufacturing of pharmaceuticals. And Germany was also very known for exporting its products. It began exporting products to Asia, Africa, everywhere. So while previously the British often used the synonym made in Germany as a propaganda campaign against German products by saying that these are bad quality, German products became synonymous with being high quality, high in precision, and very reliable. And Germany became one of the leading industrial nations before the World Wars. Now, as most people probably know, the two World Wars destroyed the German manufacturing base and industrial base. But after the World Wars, West Germany rebuilt the industrial and the manufacturing base very quickly, which often became known as the German miracle. And this is important to understand because the history of the German industry goes back a long time. So it had already a rich history in being an industrial base. So it continued with the products it has done previously. It manufactured automotives like BMW, Volkswagen, Audi. It continued being leading in chemical products and pharmaceutical products. It quickly built up to be one of the biggest economies in the entire world and very much known for high quality, reliable products. And this is where German stocks and American stocks differ, because American stocks is often focused on technology, capital goods, consumer goods, while German stocks are often much more focused on industrial companies and manufacturing companies. And it's also very much known for exporting products. So German companies are not only German, they're international as they export products to all over the world. Now a huge turn in the German economy came in the 1990s, where East Germany was integrated into West Germany. And at that time it was a huge challenge for the German economy, as they had to spend a lot on rebuilding East Germany, both socially and economically. But in the long term, and still today, it's lagging a bit behind. Now, also in the late 1990s and 2000s, Germany faced a crisis as its unemployment rose. its economic practices was seen as too rigid, and it became known as the sick man of Europe because of that reason. Now, in Germany, they passed a lot of reforms, labor reforms, to fix these problems. And Germany in the 2000s and in the 2010s rose again. The German economy rose again. And it also became very globalized, even more than it was before, by becoming much more export driven and export focused. So German economy became much more competitive. It gained a lot from exporting its products worldwide. And Germany is often seen as one of the great winners of globalization. And especially a country that's been very important for Germany recently has been China and Chinese demand. So a lot of the increase in the 2010s of the German economy came from China. The story is very different in the 2020s because COVID challenged a lot of the supply chains in Germany, but also the Russian-Ukraine war caused a big energy crisis, as Germany has previously relied heavily on Russian gas and oil, and that increased the prices when the Russian-Ukraine war happened. And also, Germany gained a lot from Chinese demand from products, but now China has become a big competitor, especially in manufacturing and industry, which has previously been Germany's hugest, which is the base of the German economy. So Chinese products are now challenging its automotives, its manufacturing, its industrial sector in a lot of different areas. So right now, the German economy is set before a huge transition. So the question now becomes, should you invest in Germany? So let's first look at the arguments for why you should invest in Germany, why it could be a good idea to invest in Germany. And the first reason is, of course, its corporate strength, because Germany is home to a lot of very big, very internationally recognizable companies such as Bosch, such as SAP in software, such as Volkswagen, BMW, Mercedes in automation, such as Munich Re in insurance, such as Bayer in pharmaceuticals. So there's a lot of very big industrial companies there. And these companies are not only German, as previously said, they operate all around the world. So they give very good global exposure too. And that's also the second argument for why you should invest in the German stock market, which is that it's a very export-driven economy. So, and since Germany is especially heavy on industrial products, if global industrial demand increases, then the German economy and the German stock market would probably do well. So for instance, if the global demand for automotives increases, then the German companies would probably do well. If global demand for industrial equipment increases, then the German economy would do well. If global demand for industrial chemicals increases, then the German economy would do well. So there's a big connection there with the global economy, as Germany is very export focused and export driven. And the third reason for why it could be a good idea to invest in Germany is because of diversification, because a lot of investors are focused very heavily on the United States, and the United States has some great companies. It could be smart to not place all your value into one place, but to make sure that you are diversified. And Germany gives that diversification, that this has more industrial companies and it has a very big global exposure. Now, a fourth reason could be valuation, as a lot of European companies and German companies trade at a much lower valuation than American companies. So for value-oriented investors, it could be a good idea. But you shouldn't just buy German stock market because the valuation is low in itself, because in itself that doesn't mean anything. It becomes strong if you think that, but the valuation argument becomes strong if you think that German companies can retain their earnings as they adapt to new market conditions that they're meeting right now. Now, another argument could be Germany's role in Europe, because Germany is the economic powerhouse in Europe and they do a lot of activities within the European Union with other countries such as Poland, Switzerland, Netherlands, Belgium, France. And this European integration and trade could be an argument in itself if you believe that it will increase in the future and everything will become more integrated. And another argument for German indices is the recovery, because as you know, they're going through some hardship right now. And if you believe that this hardship is already reflected in the German stock indices, then its recovery could be a potential reason itself, if you believe that it will recover from the condition it's now going through and become a global leader and exporter and export nation in industrial equipments again. And the last argument for the German ETFs is that Germany is a very industry-driven country, and it's very often much old industries, but now it's developing a lot. It's industrial based in robotics, in software, in renewable energy. And if you believe in this industrial modernization, then German ETFs could be a good place. The case for investing in Germany is not that Germany is perfect or that its economy is perfect, but the case for investing in Germany is that it's the home of some very strong companies. It has a very strong industrial base that is also modernizing. It has a potential recovery phase right now, and that it's very export driven, and that it gives a good diversification. Now that we have looked at the pro side for investing in Germany, we're going to look at some of the risk or the case against investing in German ETFs. So the first one is weak economic growth. So in recent years, the German economy and the German stock market has had a weak growth, especially compared to other indices such as the S&P 500. And the question is the weak economic growth going to continue in the future? Because the German model has often been focused on industrial companies that require lower affordable energy cost, a large global demand, especially from China. But in recent years, the energy cost has gone up. The global international trade has become more complicated, with a lot of countries using tariffs. China has become a lot more competitive. So a lot of people are questioning if the Germany will actually make a recovery here and get out of this period of low economic growth. So this one is a big risk, especially when it comes to potential earning. The second risk, which kind of goes into this, is the energy cost, because industrial companies often use a lot of energy. So automotive companies, chemical companies, the steel companies, they all use a lot of energy. And Germany has historically benefited from low energy prices, but due to the Ukraine war, the period of receiving low-cost gas and oil from Russia has ended, and now a lot of the industry is struggling due to high energy costs, and this could maybe even lead to a lot of the industry moving out of the country. So this is a big risk. Another one is global demand, especially from China, because Germany sold a lot of industrial products, a lot of automotives to China, but now that the Chinese economy is no longer just low-cost manufacturing, but now that it has become a lot more competitive and is producing its own cars, its own renewable manufacturing, its own industrial manufacturing, the demand has dropped a lot in China, and it has even started to take some market share from German companies. So this is a big risk. When it comes to German ETFs, it's the question if Germany can maintain its market share and compete with Chinese companies. The fourth major risk with German ETFs, it's its industry transition, especially when it comes to automotives, because German companies has been leading in the automotive industry, but now there's a big transition happening when a lot more consumers and governments want to transition to electric vehicles. And electric vehicles, they demand a completely different type of engineering, different type of supply chains, batteries. And companies like Tesla and Chinese EVs already have an advantage. They already have an advantage here, and they were just earlier to get to market with their own products. So German companies are lagging behind here, and the question is if they can catch up and invest heavily in EVs at the same time as they maintain their corporate earnings. So this is going to have a huge factor on the performance of the German ETFs and German stock indices. The sixth factor is also industrial competition, because it's not only the automotive sector that is facing competition. Both the United States and China is upgrading their industrial base, and German companies are facing more and more competition when it comes to industrial products such as machinery, renewable products, and other advanced goods. Another risk by investing in German ETFs is currency risk, because German ETFs uses the euros, and if you come from America, there could be a currency risk there between the dollar and the euros. And another risk with the ETF themselves is that compared to the S&P 500 that consists of 500 companies, the German DAX only consists of 40 companies. So it's much more centered around big global German companies, but there are a lot fewer of them. So each company would have a lot more to say on the profitability of the indices themselves. And of course, another risk when it comes to Germany itself is its bureaucracy. There's a lot of bureaucracy and it's lagging behind on digitalization, and this could affect the efficiency and corporate returns of the companies themselves. Now, the next section is going to be about the German indexes themselves. So the main index fund in Germany is the DAX 40, which consists of the 40 largest companies in Germany. Now, this is a lot fewer companies than the S&P 500 and consists of 500 companies. But if you want to invest in a larger section of German companies, you also have the MCI Germany ETF, which also have some mid-sized German companies. It's worth noting, though, that in Germany, there's a lot of large companies that are privately owned and not on the stock market. But the DAX 40 is often treated as the main stock index in Germany, and it's the fund a lot of people usually go to. Now, some things you have to check if you're going to invest in a German stock fund is if it's hedged or not. If it's not hedged, you would also get not only an exposure to German stock, but also to the euro, if your main currency is dollar or pounds or British pounds or Australian dollars. So you have to check if it's hedged or not against the difference in currency. And the main difference between German indices such as the DAX and American ones is that American ones they have a lot more companies and they're much more technology focused, and while German indices are much more focused on industry, manufacturing and export. So if you want more exposure to technology companies, if you want more exposure to high growth and you're worried about Europe's future, you should go to American stock indices. But if you want diversification to global industrial and manufacturing companies, the German indices is a good place to diversify your portfolio. Video with the conclusion is that Germany is a very impressive company, especially economically. It's one of the largest economies in the entire world. It has some great companies, especially industrial and manufacturing companies. It has companies that everyone recognizes, such BMW, Siemens. But you shouldn't invest in Germany just because you like Germany. Germany is a great country. You should be very disciplined when it comes to Germany, because there is a lot of risks with investing in German indices, such as weak economic growth, competition from China, energy shock, demographic challenges, higher aging population, valuation risk. And if you're worried that the indices only consist of 40 companies and you want exposure to the whole continent, maybe a euro index is a better way to go. So there's definitely challenges in investing in German index funds, but there's also a lot of positives. So you should be very disciplined in your approach, and you should see what your vision is, what you think will happen. So you should be very sure that you understand the market and what's actually going on. You should check if this is an ETF that fits your portfolio and your diversification needs. And you should definitely check the risk with investing in Germany, because there are a lot of risk. Because a lot of people think that Germany is just the perfect economy, but there's definitely a lots of risk associated with investing in German ETFs. Now, thank you for watching this video. Please don't forget to subscribe and leave a comment and let us know what you think about this video. Thank you.